do that. Okay, could I welcome for the last session before coffee, 3 people to stage, please. Mencia Bobo, Pave Dalal, and Ian Duffy, please. Thank you. Unfortunately, we were going to have a 4th panel member, James Binns, but we got an email from him this morning. He'd been to India for business last week, and he's come back with certainly a virus of some kind and not feeling too well. I'm not going to go into detail, but suffice to say, he's not going to be on stage today, which is a real shame. But sending our best wishes to James. So welcome, panel guests. Great to see you all on our conversation online a couple of weeks ago. Welcome. Can I maybe just ask you quickly to give a very high-level introduction of yourselves? Ian, maybe starting with you.
Sure. Ian Duffy, I'm founder and CEO of Accelerated Payments. We're an invoice financing and trade finance company based out of Dublin, operating in Ireland, UK, US and Canada.
Thank you. Mencia?
Yeah, Mencia Bobo. I'm globally responsible of the trade and working capital solution business within corporate investment banking in Santander, based in Madrid, and I've been with the bank for the last 17 years in different positions, from project finance to structured finance risk, and lastly in this new role in trade finance.
Hi everybody, I'm Parvez Dalal. I'm based in London. I manage Citi payables finance business, primarily supply finance and dynamic discounting, deep tier, second tier, purchase order financing. We offer supply finance across 122 locations globally. We are the largest provider of this business in the banking and fintech space. Our next best competitor is 4 times smaller to us. I'm glad to run this business for the last 3 years, and I've been in Citi for 14 years.
Great, thank you very much. So I've got a couple of pre-prepared questions, but we'll leave enough time if we get some interest from yourselves to ask the questions. Otherwise, we'll be moving to coffee. But my first question, I'm going to pose this to Ian, if I can, first. We've had 12 interest rate hikes, certainly from the Bank of England recently, and we've seen those rate increases across the pond as well following. I mean, this material shift in rates, do you think it's affecting not just banks, but financial institutions' ability to compete at the moment?
Yeah, so it's pretty significant. It's probably getting back to normal, as opposed to, I mean, 0 interest rates, which we had for quite a long period of time, was never sustainable. So this is for those of you that have long enough on this planet. Remember, normal was 4 to 6, in that range. It is a big adjustment. It's a big adjustment. It's a big adjustment for clients in terms of the margin that they have to pay for funding, and it does have a very significant impact on my sector, which is the non-bank funders and non-bank lenders. We don't have access to retail deposits, which is a major negative. So I think it just pushes in the sector that I'm in. It pushes us for consolidation and to get to critical mass so that we can borrow efficiently and effectively from the senior debt and mezzanine debt markets. I think that can be done. So that's and I think, look, we're small and agile. In our instance, we're not regulated, so that gives us a price advantage in other areas. So on balance, I think we're good, but it's a significant adjustment. Yeah, very, but welcome.
Again. We don't want it to double again.
Basically.
Sorry? We certainly don't want it to go up another 12 times.
No. But it needed to happen, so we might as well get on with it and make the adjustment, and I think that's what's going on in the market. But ultimately, it will have to be passed through to clients and borrowers. That's the reality for all of us.
Mencia, your point of view?
Yeah. No, so I completely agree with Ian. No, so I think for me the answer is it depends. No, so does it have an impact? Of course, we come from a period of very free liquidity, very low interest rates. Obviously, the current adjustment is impacting across every player in the financial and non-financial sector. But what is true is that depending on the player, it will face it one way or the other. You were mentioning, Ian, that depending if you are a bank, you have access to retail deposits, and if you have been preparing yourself, you have a quite good diversification on the funding sources, you are better prepared to face this situation. Another thing is what is your capability to transfer this increase to the final customer? Is this possible, depending on the industry? My answer is, depending on the value-added products, services that you are giving, you will be more able to do it or not to do it. You will be more competitive or less competitive in this new environment. So basically, the answer is that in this case, as in every other adjustment, there will be winners, there will be losers from the situation, but no one is impacted in the same way on the current situation. And by the way, I think also there is now that we are this conference is about receivables, about supply chain finance. I also think that in terms of bank financing, not all the products are going to have the same impact. Products like the ones that we are discussing in these 2 days probably are also facing less of a problem with the current situation that if we talk about, I think that was mentioned by the professor, no? The leverage finance market, the real estate market. This is our businesses or financing that is going to be highly impacted for the situation.
Have I anything to add? Or?
No, I think I agree with Manika's observation, right? Today, 2 days, we're talking about receivable and payable. It's just not the cost of financing. It is how you impact the client balance sheet and how you deliver efficiency is very important. From a longevity perspective, I think larger, bigger players with deeper pocket would withstand the cyclical challenges that undergoes regardless of pandemic, interest rate, inflationary, whatever you can tell it, right? So they can build some sustainability into how they operate. But I think it's about how you deliver your product sets to the client, how you add value in their financial position, and eventually the end user, the consumer, will have to pay the price. And we are seeing that in the increased inflationary pressure and the prices increase. It's all creeping into the end consumer paying for the increased cost. So yeah, but from a long-term perspective, I think receivable payables is a very good product sets to stay, and we've seen the increase in the GDP versus the global trade. So there's a lot more to be done, I would say.
Very encouraging, yeah. Personally, I hold a couple of ISAs in the bank. I won't say which one, but I'm only getting about 2.5% return on my ISA, so I'm interested to see the actual bridge between passing it on to the retail customer and borrowing their money to sort of advance that to the businesses. So if you've got any ISAs out there offering more than 2.5, give me a call. Second question I've got is around ESG and sustainability, and I believe tomorrow there's a session on that, Wayne, as I understand. But I'm really keen to hear your views on this in terms of, I'm hearing even the credit insurance market is turning more towards applying non-financial factors and considering those as part of their decision making. I'm just interested to know what's going on right now in your business in respect to ESG.
Yeah. So this is also, we are facing also a lot of progress, no? If I think a couple of years ago, how we were facing ESG in the financing products, in the financing business, was everything about products, no? How do I offer green products? And it was more about that, no? General purpose, I do green guarantees, but again, product approach, although it still contributes, it is positive, but it was not a profound change on the mentality and on the culture of embedding ESG. Then it came to sustainability-linked products, no? This is broader scope. You can get more part of the ecosystem in every transaction. So for instance, sustainability supply chain finance is a way to go to your clients and depending on the base of suppliers, you can really tackle a big amount of counterparties there. But still product approach. So what we have done lately, and I think it makes a lot of sense, is combining this product approach also with a sector approach, meaning we need to identify what are those racing industries that are going to be the ones that change and that help on the energy transition, and be able to support these industries from the early stages. There sometimes you find startups that are the ones that are driving these changes. They don't have so many access to banking products, and is there the key to make this, to accelerate the energy transition. So basically what we are doing now is with experts on the material, with the appropriate risk frameworks, so what we are doing is being more proactive, having more risk appetite on this type of industries, even though the size or the early stages of the company, combined with solutions, and then being able to accelerate or to contribute more to this energy transition status.
Ian, from your perspective?
Yeah, I think so. I'm the minnow at this table. I'm two big 800-pound gorillas here, metaphorically, of course.
I can say for me, not for her. Lighter weight.
So I think the biggest. So look, ESG is here and needs to be here. For all of us, not just for ourselves, but for the next generation, and it's vital. I do worry about how blunt it's being applied in some of the funding that we're seeing. I was reading an article about, again, electrification of cars, and in Ireland, we import most of our fuel. So, like every other country in the world, we're seeking to raise the percentage of electronic cars, but it's still all being in reality fueled by electricity that's generated from fossil fuels. And so if you applied ESG into that on a crude, blunt phase, actually it might not qualify because it hasn't reduced fossil fuel emissions. Yeah. I mean, that'll happen, and we're transitioning into significant wind investments. So that's our concern as a taker of funds from the debt markets, in that we're seeing ESG criteria being put in. We're seeing it's very blunt. And it's one solution, and I think there needs to be. I think that's good. So it's not a trend I'd be proposing we reverse, but I think there does need to be a component of conversation around. Well, what does that mean? And actually trial and error in terms of getting into the detail of what the implications of that is, because I do worry it's a little bit. Fossil fuels tick. So what does that actually wipe out in real terms, in terms of direct and most importantly indirect? So it's a concern. I think it's a good trend, but from what we're seeing, I think it's still in the very early phases of adoption and still rather blunt.
But taking that a bit further then, Barbara, maybe I'll ask you, but if you're looking at saying it's very blunt, does that mean to say we're going down a pathway of yes or no, or do you think there'll be pricing differentiation evolving in order to show that the more ESG compliant you are, the more you're into that area, there's going to be a relaxation or an easing of price, and there'll be an increase for those sort of products, sourcing of goods that don't fit the criteria?
No, I guess we are all in the financial product space, and we cannot go and reduce the carbon footprint of our client. We can offer incentive for them to be adapting to a better environment and reduction in the carbon space. So yes, the financial incentive is a good way to drive the universe towards more sustainability, and that's what we all are doing. We are incentivizing our clients to offer cheaper and a better product if they are sustainability linked. Having said that, I think if I look at 2-3 years back, our working capital team have never been asked to put in our DNA as ESG linked products, right? It was more a capital market play, and people were buying plant and machinery and looking at how they can reduce the carbon footprint or an emission and stuff like that. It has become a day-to-day affair. As a consumer, you go and buy, you like to buy an organic food, for example, or a farm egg, So obviously it is driven globally. I think the challenge for us is how we operationalize it, how we monitor that, because there's a lot of greenwashing that we talk about from time to time. There is no perpetual certification that you can issue to a supplier saying that you are an ESG compliant and will stay forever. So there has to be that process, that mechanism to track it, the agencies and the standards. You have softer standards, which is more qualitative standards, and you have a quantifiable standards. And if you adopt a quantifiable standard, that requires an ongoing monitoring. So there is a lot of complexity. It's a very big topic. There are multiple standards. Your clients, which is, if you're talking about scope 3, then your client would adopt a sustainability standard, but their suppliers will have to adopt it. So you're not talking to the operating environment of your client. You're looking at their supplier, which are not even the client of the bank, and you have to monitor it. So you need to understand the dynamics of how we are operating and how we are delivering. Having said that, we have some really good success stories. We have developed multiple programs. I mean, I can talk about all the banks put together. When I see the list of ESG deals, there is a long list of ESG deals which each one of us are doing. So it's a great step forward, But are we there yet? I don't think so.
I certainly think the transactional risk analysis that's embedded now in trade finance to a large degree will help and drive more structure than where you have an overdraft or you're not asking who's the customer or what's the end use of those goods. I think that, all of these things and traceability are going to become probably more beneficial for asset structures than non-asset structures. Moving into something Professor Altman said earlier, it's worried me a little bit. What does 2024 look like? From his predictions, it's going to be a lot more challenging. Certainly speaking to some credit insurers as well, there's a view out there that the market might be getting a little bit more tougher. Bankruptcies are going up. So I guess with those sort of uncertainties, what's happening around the risk-weighted assets? I'll talk about the banks first and the distribution of those risks from your balance sheets. I know some have started to do that, even driving down into commercial banking now and distributing assets away to drive that efficiency and risk mitigation. What's happening in, let's say, your bank, Pave?
So I think we are a very early adopter of how we churn our book, not just because of the constraint on the credit of counterparty, but being operating in 122 locations, if a client decides to go with one bank, he will bring in his relationship banks to share the wallet. It's a natural ask by the client. So we, 6-7 years back, we created an infrastructure where we could incorporate all the relationship banks into a program and distribute the program equally to all of them. Virtue of that, fast forward today, we are again the largest distributor of supply chain assets globally. And I can quote a number, is Chettenham House. So we distributed close to $160 billion of assets last year, which is a huge number in terms of the scale and the size we operate. Is it because of all credit concern? No. Our 90% book is investment grade. We can hold all the exposure. It's short term, uncommitted, 90 days, so no risk from a counterparty perspective. But it brings in the efficiency, balance sheet efficiency. It brings in a globality and a scale at which your clients would expect you to do. And it also brings in the RWA requirement of a bank that if they want to operate in a certain risk-weighted environment, then you could technically deliver that in a scale and a size that you operate on. I think it's also important that supply chain as a business has been so widely spread in fintechs and banks that everybody, if you have a technology, could offer it. But the difference in the offering is all about execution. How you execute it, how you deliver efficiently, how you withstand resilience in terms of all the pandemic, economic, credit cycles. And if the supplier keeps getting paid on day zero, then you are a winner, right? And that brings in the risk-weighted asset distribution in a very effective way. You need the technology to work, because if you are operating at such a scale and size, they cannot be manually done on a paper. So you need a digitized solution, you need the technology, you need to have the connectivity, you need to have a wider adaptability of bringing in not just the banks, relationship banks, but the private investor, hedge funds, and the development agencies. So it's very important that the development agencies also play a critical role, not just for sustainability financing, but for going and funding at a grassroots level to the last mile suppliers. So you need to weave into all of that, into your infrastructure, which has to have the scale and the size at which your corporates would like to see.
Mencia, any additional comments? Or?
Maybe a very quick comment. So I agree with also with Parvez that for us the distribution has not been ever about risk. It was more about efficiency on risk-weighted asset. So this is one thing. Now, what has changed, and it's going to change even more on the years coming, is also distributing because of liquidity. So first was capital, now it's going to be capital plus liquidity. And then on the positive side, what we are seeing, observing outside is that there is more appetite for this type of assets in the industry. If before was a pure market of banks, insurance company, what we are seeing is other players with a lot of appetite. And that the environment is getting worse on 2024, only placing in the favor of a supply chain finance asset, because we all know loss ratio of this type of assets is much better than any other financing assets. So this makes that if investors already had appetite, it's going to be even more appetite. So this only enhance the machinery of distribution that we can start moving into this trade finance in general.
If it's done correctly.
Eh?
If it's done correctly.
If it's done correctly.
Yeah.
But again, that's why it's important that you don't do it. So this is an important comment, because that's why it's important that banks shouldn't be distributing assets because they don't like the risk.
Yes.
That is the important issue. So for us, it's critical. So we always need to maintain a skin on the game on every asset that we sell. We need to keep something in our balance sheet, and I think this is a key part.
Ian, I know you've sort of got different structures in APL.
Slightly. Slightly smaller. I mean, if I was listening to Parvez's figures there. If we got 0.1% of his, we'd be having a fantastic year. And look, that's the niche we're playing in. We're playing in a completely different niche. We have to be very adept. We have to use technology. We have to write business very efficiently. I think there are going to be strong headwinds over the next 12, 18 months. That's already started. But I think that's an opportunity and not a risk. We need to be more selective, more information driven in terms of where we're taking risk and not. But we see it as a very good opportunity for the non-bank lenders over the next 12, 18 months to 2 years, because I think there's going to be a rump that larger banks will find it hard to write because it's too small or it's not consistent enough. And I think there's going to be great opportunities for the non-bank lenders to pick up that business and keep that business. And just as an aside, I think long-term, actually, our key strategy is one of partnership, because we think partnering with the bigger banks is the way forward. We're adept, we're niche. Working capital is typically labour intensive, it's process intensive, and therefore it suits companies like ourselves, rather than big established banking environments and IT solutions. So we think there's a long-term partnership to evolve. It hasn't evolved yet, but I think that will happen over time.
Okay, thank you. And just adding to that, I guess if you look at some of the big investments coming into the world of invoice finance, supply chain, that the yields or returns the investor can get is really attractive. That will come under some challenge, I guess, as the interest rates start to spike up, maybe less risk and an alternative way. But nonetheless, I've seen quite a lot of inflow coming in to this space. Some people not necessarily with the experience of running it, but nonetheless, they seek out a very attractive return. Some of them aren't achieving that result and are failing, but others are doing really well. And what I'm seeing is also some challenge to our traditional ways of working with disruptors that are starting to become quite material in our space. If you had to name some of those disruptors, who would be on the tip of your tongue when you're thinking about the new markets, the new ways of working? Menzi, I'm going to start with you, yeah.
So, to be honest, if I think, I totally agree. No, so there is a lot of disruption in the market, lot of new entrants in the market. Some doing well, some not doing so well. But I come to Ian's previous comment. I think in general, or I would say, yeah, I think probably all of these new entrants will need at some point to partner with some banks. Okay, and I think, by the way, banks also need to partner with some of these new entrants. So if we think the amount of transformation that we are seeing in the market is so holistic, the things that we need to tackle, it goes from technology, it goes from risk models, it goes from so many things, we understanding procurement process. So it's so many things that no one in its own has the capability to tackle everything. So these new disruptors, there is some ones that are big, someone that for banks can be a little bit concerning, but I doubt that any of them can succeed without taking into account banking or financial institutions in general. So I'm not naming any of them, but
You're not naming any of them, okay? That's interesting.
I'm not naming any of them, but none to think too big to be a threat. There can be big, but not to be a threat.
Okay. Ian?
Yeah, I do think that's the future. I've used this analogy a couple of times. If I'm flying to Akron, Ohio in the States with United, I fly on a United airplane from Heathrow to Newark, and then I get on a small puddle hopper, small plane that's not owned by United, that's owned by an agent of United, and they run the last 300 or 400 kilometers. And I think the same model is going to evolve in the financial services world. I think, in terms of doing 100 million, 200 million, 10 million facility, the banks are always going to be more competitive on a straight term debt. But where they are going to struggle is where there's more administration, it's more complex in terms of a transaction. We can bring adaptive technology to solve that problem that's outside core banking systems and legacy systems, and I think that combination is exciting. It hasn't evolved. I think the banks have not embraced it yet, and I think also, frankly, if I'm being critical on our side, we haven't reached a critical mass where we're making enough noise. Say, come look over here. We're up to 500 million or 1 billion of a book, and I think that's so. I think that will happen over the next couple of years. Probably needs to be more consolidation because there's quite fragmentation in our sector. So I think consolidation will help as well. But it's still very early stages in real terms in terms of the evolution. It's
So I'm going to name some names. Yeah, I mean, what about people like Klarna and Amazon and others that are sort of offering, extended finance at point of sale or purchase, should I say? And maybe considering if you could see a world where you've plugged into accounts packages and the accounts package can infiltrate the assets of the balance sheet, whether it's a sale and lease back, it's the inventory, it's your debtor book with name and address list, and you've got the right pipes for funding and limit. Do you see a world where maybe there could be a crossover?
But that's exactly what I was mentioning before. Think about, you mentioned Klarna.
Yeah.
Klarna works with banks.
Right.
Klarna is not doing extension of payment terms with their own. Yeah. For Klarna, getting funding, their own is very expensive. So
Sure.
They need to have a bank behind that is able to combine all their offering, which is very good, but they need to combine all the offering with a bank behind that does what you say. Either it's a securitization, it's a normal residual finance program, it's whatever, but they still need cheap funding coming from banks. So
cheap. Okay.
That's why the right, that's why I agree with you. And by the way, I'm even from a banking perspective, I do see that we should be moving towards that kind of partnership. It makes all the sense. Yeah. So Klarna puts something which is very powerful, but again, combined with a bank is even more powerful.
And there are some legacy systems still within the banks that going to take years to resolve. You know, I'm not talking about any particular bank, but that in itself can just, the prioritisation to change the IT, to have the time and bandwidth to do it and keep the engine running is tough. Where if you've got these agile businesses that can sort of work with you, it does make some commercial sense, I think, from a bank perspective. But I guess my final question, I'm going to start with Pavel if I can, is apart from scary films and bedtime stories that scare you, I mean, what keeps you awake at night? If you've got to think of one or two things that, you know, when you're laying in that bed, you've got your notepad maybe by the side or not, what is it that's on your mind?
No, I think there are the risk at which you operate a global business always keeps you worried as to where there could be, you know, situations which require an urgent attention. So we are, half of the time, our mind operate on a strategic basis as to how we complete our client value chain and deliver solutions. And I agree with Jan and Mencia that we also have partnered with a lot of fintechs and newcomers to complete the client value chain. I think Jan gave a very brilliant example of flying into United to Newark, and from Newark you got on a partner plane. So we need to embark on that journey, and the partner's environment equally is important from a regulatory lens perspective and fitting it. So it keeps us awake at night to think of what would go wrong, because it's a heavy operational business, right? While we claim to be 98% digitized, there is always an element if you operate in 122 locations with 74 currencies to settle. It's going to be, you know, fire anywhere. But is that fire kind of an addressable within the globality of the business that you operate? And if answer is yes, then you are at rest of this. Secondly, I think the world has become a lot more uncertain in the last few years. You know, leave alone pandemic, the geopolitical situations, the country and the credit situations, you know, the insolvencies. They all keep things on the edge. The rising interest rate, you will see the reduction in the kind of financing coming through your door, whereas the throughput keeps going up, the scalability. So these are multiple factors. It's not one thing which you address one and immediately the next big issue pops up, and then you need to address that. So you break your mind into two parts, 50% strategic, but 50% you have to be tactical, you have to be grounded, you have to be close to the clients. Otherwise, it's very difficult to manage a business.
So about 2 hours sleep a night by the sound of it. Very good. Thank you. Ian?
Yeah, I think if you worried about all the things you could worry about, particularly in the last 5 years, you would be a wreck. Somebody coined a phrase, permi-crisis. It seems to be we're in a situation of a permanent. There's always a new crisis coming every 6 or 9 months. So look, I think my reaction is always to deal with what I can control, and what I can't control, I can't control. So I think there's a lot of challenges. Our biggest issue is scaling. You know, that's what we need to do. But there's nothing keeping me awake. As I said, I think it is going to be strong headwinds from a macroeconomic perspective in the next 12, 18 months. But I think that creates opportunity, particularly at our scale. So we're quite excited about that. And I'm sure there will be another crisis that none of us have even thought about here in 3 or 6 months' time, if it comes on time. And that's fine. We'll get through that as well. So hopefully getting my sleep, Steve. Trying to anyway.
Good. That's good to hear. Mencia?
Well, I am little to add, so I agree. I agree very much with Parvey. So it's the question of how fast we are seeing changes. The pace of changes in this current environment is much faster than it was before. No, so it's a lot of changes and in a lot of things. So again, if we come changes in the way that customer patterns, business models of our clients, digitalization, obviously big macroeconomic changes. So there is energy transition. We also spoke about it. So there is many things goes very fast, and my concern is whether we are able as an industry to transform ourselves at the same pace that the society is requiring, because the risk of not doing so is coming back to, I think Mark was commenting at the beginning, in the first panel, is that this trade finance gap that we have been for years speaking about how we can untap it is becoming bigger, and it's not coming bigger only in developed countries. Also in developed countries is going to be a problem. If you see clients selling more to SMEs, for instance, just to put an example, it's again a problem of how you tackle it. Now you need to change our business model from the financial institutions to also be able to cover. And again, if we are not able to adjust, we will only increase this trade finance gap in the coming years.
Thank you. Any questions? Got time for one or two? We can have.
Just the panel. When you get down to, so I agree with you said, Ian, it's a huge opportunity to grow your business because other people start pulling in. And I'm not really involved in the industry as I was on a day-to-day basis. But do you find that, and to me, people are now the number one asset again? Do you find that the market has enough people on board to take advantage of the opportunity in the marketplace that have the experience and training?
Is it for me?
But for the panel.
Yeah, so, well, that raises another issue which is very prevalent, which is remote working versus office working, which is another great debate. So to answer your question, I think those resources are there. We are fully remote. We went fully remote June 22, and face-to-face is the ultimate. Obviously, this room proves it. But in order to keep the caliber of people that we need, which are more experienced, we tend to be employing people in their late 30s, 40s, 50s, because unfortunately we're not big enough yet to be training and taking on that mantle. So in order to keep people, we've had to be able to operate remotely. And we think that's one of our key aspects in terms of being able to retain staff. And I have great debates with people in terms of forcing back to the office, and the benefits and the cons of one versus the other. And I do think there's a permanent shift in terms of remote working, and we need to find a way to embrace it, and how the virtual world can compensate as best as possible as face-to-face, but it's never going to match it. So I think the resources are out there, but we've had to adapt in order to get those resources, and it's working. We are sticky, in terms of keeping people so far anyway.
Can I just add a couple of things, Ted, from my point of view, if that's okay? That three things. One, and I remember being part of this journey in the larger corporate and the large multinational segments, especially in the banks. We sort of got away from the expertise a little bit, so we started to blend the expertise of trade, maybe payment, cash management, invoice finance. And so people that had grown up with that very dedicated focus and lens on the particular asset they were good at. I found that when we merged those people, they still stayed more prevalent to what they knew most. And therefore, I'd question whether it was giving the client still that sort of balanced view initially. So I think we've lost a little bit there. I've been back to a couple of schools delivering to A-level students education around trade and invoice finance. And what was scary, it's not even on their curricula. So if they talk about overdrafts, they talk about MCAs, they talk about possibly leasing, cash is king, but they don't get into the value of inventory, invoice finance. And so even when you're leaving for an education process, your mindset is on overdraft. Your mindset is on that type of working capital. So I think that's an issue. And the third one is, as Ian said, we are remote working in accelerated payments. And I do think some people have made a lifestyle choice through COVID to maybe transition to working 5 days a week and have a different view on life. But I do worry about, again, that next generation where they're getting enough rubbing of the shoulder with the expert and having that education passed through as a legacy. And I feel, again, we've got a bit of a concern. I've got a bit of a concern for the industry as a whole, to see where those next experts are coming from to lead the change that we will need around this area. Because the biggest issue we face is fraud. And, detecting fraud, understanding, kicking the tires of the invoice, the asset, knowing, you can use Dedica TradeNet and other sort of capabilities to detect. still comes down to a sniff test. You've still got a gut feel on some of these things. And for me, that is a concern when I look at the market.
Yeah.
Sorry.
People.
People
So
matter.
it's very fraud,
100%.
And you need experience
Yeah.
with that.
Yeah.
So
Okay.
I think a lot falls on the industry associations to make sure they're really pushing their training programs.
Yeah.
That includes
And making it attractive.
FCI, etc.
Making it attractive.
Yeah.
You know, why would I go into invoice finance?
Yeah. And if I,
Big role.
and if I may, because maybe I agree, most of the things I disagree in one is that it's good to find experts on the material. So saying, okay, I have for 20 plus year expertise in trade finance, that is very good, but we need to combine this with another kind of expertise. And I think it's the problem of this industry, that is people that has been doing the same for a long time. And when it comes to big transformations, you need to put a little bit of fresh air on these changes, and people that come from different profiles and backgrounds. So you were speaking about inventory. Inventory is a lot of financial background, but it's a lot of procurement. It's a lot of so you need technology in the business. People with a very deep knowledge of technology in the business, not in the COO areas, but in the business itself. So profiles needs to change, and we need to put young people that comes with a fresh mind, that knows what is happening, and that doesn't come with the same background that it has been historically in this industry, no?
Completely.
Yeah, but I think.
Yeah. Go ahead. Trevor, yeah.
Sorry, go ahead. Yeah.
No, go on.
No, I think I agree. I'm slightly old school of thought, right? Sorry about that. But I think, over a period of time, if you have seen multiple challenges, frauds, bankruptcies, whatever you can call it, that leaves behind a sort of your DNA especially if you're dealing with the credit and if you're dealing with larger counterparties, you need some thought leadership to frame up that environment. And then you need Gen Z to come and look at the technology and how it is going to play up, etc. It's also a trial and error in my mind when we deal with younger generation. They tend to not be as successful as you want them to be. Because at the heart of it, we want our people to grow. And sometimes they just cannot cope up with the scale and the size and the complexity that you're dealing with. That comes with certain maturity, certain experience, but at the same time a mindset. And I agree, technology has been playing a big role in the last few years. So it's a blended thing, but I think there is a bit of, I would say, lesser importance given on the training and educating on the trade front. I think we need a bit of more grounding. When you start with operations, you know how this is going to be operated. And that is a very good starting point in my mind.
Thank you. Ian, just 1 minute.
I was going to say, we can eliminate 95% plus of the risk, as you were saying, Mencia, by managing the process, helping the client manage the process better with the buyer, and then the invoicing function just happens off the back of that. So that subtle shift, because what bankers tend to do is track a piece of collateral and put it over here in a safe place so I can look at it. And what we're doing the opposite. We're saying if we can connect the two parties on the transaction and verify the data, then the next piece of financing that is just a small step. Yeah. And that's the key change, is to take out all the friction that happens and just let those two communicate, be an observer of that communication, and then the financial piece is just a flip.
Fantastic. Thank you. 3:30. I'm so excited about getting on time. Can I just say a massive thank you to the three? Are you staying for coffee?
Yeah.
Yeah, and for the session. So if there's any questions, use that opportunity in the next half an hour to sort of network, ask, three great experts here on the panel, anything you might have. Coffee break, back in at 4:00, ready to start again. Thank you.